Hey you guys, I'm Carson Rouse, back with Business Buzz, where we focus on business, entrepreneurship, and investing. Today, I'm going to be going through the differences of passive and active investing and trying to figure out which one is best for you. If you're just getting into investing, you have to know the difference between passive and active investing. It's very important. They're two very different strategies, and they're two completely different ways of looking at your money. This has been the topic of some heated debates between different wealth managers and stock investors. I mean, it's a huge thing. Some people say passive investing is the way to go. Others say active investing is the absolute best way to go. You're going to make way more money, all sorts of back and forth. However, I'm just going to be going through some unbiased facts about which is better in each scenario, and overall going through the differences between passive and active investing for you to make your own opinion. But before we get into all that, make sure you guys go down and like this video. We really need more likes on our videos. We're not getting enough likes, you guys, so I'm holding up an L. I didn't mean that. Go hit the like, please. First, let's start with passive investing. This is the most popular form of investing among most investors. If you're a passive investor, you're somebody who's investing for the long term. You're thinking decades ahead, and you're someone who doesn't like to constantly be touching your stocks. You don't want to constantly buy and sell and trade your stocks. You just want to sit back and watch them grow. A lot of people have trouble with this strategy, however, especially new investors, because you're going against your own human nature. Because when the stocks are plunging and everybody's selling all their shares and you're seeing all this money that you're losing, the average instinct that you go towards is sell, sell, sell. But with passive investing, you want to sit back and say, hey, you know what? I'm thinking long term. Years from now, this won't matter. And that's how you got to think with passive investing. And it's hard, it really is. So with passive investing, selling your shares all the time and buying new stocks and all that flip-flap is not going to go over for you well. With this, you want to have a long-term growth mindset and say, hey, you know what? I'm going to pick some value companies that bring solid dividends, solid growth, but nothing too crazy. And I'm going to stick with those for a long, long time. A very common passive income strategy is to just buy into index funds. We've talked about index funds a lot on this channel because they're just great for beginners. Most commonly, people like to invest in index funds that track the S&P 500. The S&P 500 is basically the 500 largest companies in the United States. And so if you invest in an index fund that tracks all of them, you're very well diversified. So if one stock plunges, all the other stocks will make up for it and you'll consistently make money. On average, you'll make around 8% a year, 8 to 10%. Again, the most successful passive investors, they keep their eye on the prize. So they're not worried about little swings in the week or the day or even the year. They look years ahead. They look 20 years ahead. A lot of them don't even check their portfolio every day. A lot of them say, you know what, I'll check it this week, I'll check it next week, but I'm not going to constantly think about it. One of the best perks of passive investing is that you'll actually be saving a lot of money, right? So a lot of times with brokerage accounts, every time you sell or buy a stock, you're going to have to pay fees. Not to mention you'll be saving a lot of money on taxes. Because if you buy and sell a stock within 1 year, you're going to have to pay a much higher tax rate than you would if you bought it and sold it after a year. So long-term capital gains, way better for your taxes. The big drawback with this strategy, however, is that you are limited in how much you can be making. Not technically, but usually you're not going to make as much, especially if you go into index funds. While your returns are more safe and steady, they're not going to be as big and boisterous. Like, for example, let's say you put all your eggs into one basket, you put it into some random penny stock, you could end up making millions. However, if you put it into an index fund with little pieces of a lot of different companies, you don't have as much room to grow, but your returns are much safer. Now let's get into what is active investing. Active investing is much different. It's obviously a lot more active. There's a lot of buying, selling, and shifting depending on what the market's doing. The common goal of active investing is to beat the market as a whole. If you're a passive investor, you can still try to beat the market by picking some safe stocks and stuff, but active investing, you're really trying to beat it. Active investing tends to be way more difficult and involves a lot more analysis of a stock. Generally, with active investing, you're going to be doing more technical analysis, as with passive investing, you're going to be doing more fundamental analysis. A huge benefit of active investing is that you have full control of your portfolio of all times. If you're a little iffy about a stock that you own, sell it. For example, instead of going out and buying an index that tracks the S&P 500, like 500 different stocks, you can buy a few that are within the S&P 500 and constantly switch them around and switch how much you're invested in each. Active investing also allows you to get into some hedging in the stock market, which involves using call and put options, which make your returns way more higher if you get them right. A big con to active investing, though, is that you're going to be paying a lot more, especially if your brokerage charges you for every trade that you make. You're going to end up paying a lot of money in fees, not to mention, again, your taxes just won't be as neat, and you'll be paying a lot more. But now let's go into my final thoughts. In my opinion, both strategies are better for two different people. Some people, it's way better for them to be an active investor. Others, passive investing is the only route they should go. Personally, though, I go for passive investing. I like going a little safer. I don't feel that I know as much about technical analysis to go into all that, and I don't think it's realistic to try to beat the market insanely year after year after year. Some guys can do it, and women, but I just can't. And again, it's a cheaper way to invest, dealing with different taxes and fees, and generally for new investors, it's the way to go. When you don't know a whole lot about stocks, put it in an index fund. Although if you're someone who's looking for insanely high gains, active investing is the way to go, no doubt about it. Thank you guys so much for watching this video. I really hope that some of you guys took something of value from this video. If you did, make sure you guys go down, like this video, subscribe to our channel for more stock content and other business videos. Anyway, I'll see you guys next time.